Welcome back to Chapter 5. We're going to move on in the chapter and talk about receivables and the way that we might have some trouble collecting on those receivables. Now remember, receivables are any money due from another business or from an individual. And there's three ways of thinking about receivables. We can think about accounts receivable versus notes receivable. Now, one of the big differences is a notes receivable is usually a legal document. It will list the amount that needs to be received. It will have an interest rate associated with it. It will have a maturity, meaning a date that needs to be paid. It's a much more formal document. Accounts receivable come from invoices. Now, invoices are also legal documents, but far less formal. Another way to think about receivables is current versus non-current. Now, if you remember from earlier chapters, current, we used to say means due within less than a year. When we're thinking about receivables, current usually means due within 1 to 60 days versus a notes receivable, which is usually a little longer, 3 to 12 months. Notes receivable are still not usually longer than 12 months. The other way to think about receivables is trade receivables versus non-trade receivables. Trade receivables result from a customer purchasing inventory, so wholesalers selling to retailers. Non-trade receivables are from some other transaction that doesn't involve a customer buying inventory. Now, the major focus of this video is how do we deal with bad debts? Now, what does that even mean? Well, if you're going to have accounts receivable, and you're going to essentially extend credit to some of your customers, then you have to expect that some of them are not going to pay you on time. Some of them may not pay you at all. So that results in this situation called bad debt. It comes from a customer not paying you. Now, in the accounting world and in the legal world, the fancy term for non-payment is a default. And we record this as an expense, actually. And if you recall, expenses are debit amounts. Why is it not a contra revenue? Remember, we had sales discounts, we have sales returns and allowances. Those are both contra revenue accounts. They're debit entries that reduce the total amount of revenue. Well, a contra revenue reduces the total amount of gross sales so that we can arrive at net sales. And it results from the action of the seller. A sales discount is the seller's choice to offer the buyers a discount for paying early. A sales return and allowance is the seller's choice to give some money back or money off because the customer might have been dissatisfied, but it's still the seller's choice. An expense, obviously, because it is an expense, it reduces net income, and it's the result of actions of the customers. I don't think there is a selling company out there that would choose to have a customer default. So this is why we call it an expense. It's bad debt expense because it's not up to the selling company to determine whether a customer will pay or not pay. They obviously hope that all customers pay. Now there's two ways to deal with bad debts. As a company, as a selling company, you can sit around and wait until a customer defaults, and then you would put debit that amount to bad debt expense and credit your accounts receivable. Obviously, you were sitting around with some debit in your accounts receivable. You expected to get paid. You didn't get paid, so you have to reduce your accounts receivable with a credit entry and you debit bad debt expense. Here's the problem with that. Remember that matching principle from our generally accepted accounting principles? If we sit around and wait for the bad debt to happen, then we are not matching expenses in the same period as when the revenue occurred. And remember, we have to match expenses to the timing of revenues. It sometimes takes customers a year or more to actually default on their payments. And so we don't use this, what we call direct write-off method. We don't use it. Not in GAAP. Do not use. You may want to, but don't do it. Instead, because we are good GAAP accountants, we're going to use what is called the allowance method. The allowance method is a two-step process. First, we estimate what we think bad debts will be in the same period. Remember, I have to match my expenses to my revenues. So I'm closing an accounting period. Maybe it's a year, maybe it's a month. And I have to estimate based on all of the revenues of that particular period, how much of them will be bad debt, how much of them will be defaulted on. This will properly use the matching principle. Whatever the amount is, whatever I estimated the amount to be, I will debit that to my bad debt expense account. Now, I do have two ways of estimating it, the percentage of credit sales method and the aging method. We will go over one of those in just a moment. After I've debited bad debt expense account, I will have to credit this new account that we're introducing called the allowance for doubtful accounts. Now, what on earth is the allowance for doubtful accounts account? Well, it's like a holding pen for my estimates of bad debt so that I can have it sit somewhere on my balance sheet. It's actually a contra asset account, another one of these contra accounts, and it'll sit there until I've determined that there actually was a default, and then I can actually reduce my accounts receivable and clear out that allowance for doubtful accounts account. All right, so when I believe that there is going to be a certain amount of bad debts, I'm a company, I think that generally I have a certain amount that always seems to be defaulted on. In the same period, I have my debit to bad debt expense and my credit to allowance for doubtful accounts. And then after I do that, I have fulfilled the matching principle, and then I'll sit around and wait to see which customers will actually default and how much they will default on. Now, I promised we will actually only look at one of the methods for estimating bad debt expense. If you have been through Chapter 5 already, you notice that there were two methods. We're only going to look at the percentage of credit sales method, and this is how it works. Essentially, the company has a rule of thumb, an estimated percentage of credit sales that they think are usually uncollectible. Where do they get this estimate from? Usually based on the history, the company's history, and whatever the managers are currently predicting. We take that percent and we multiply it by the total credit sales. Now, if you notice, we keep saying total credit sales. It's not total sales. Because if you recall, a company can get some of its sales in cash up front. Well, that's not uncollectible. It has been collected. So this is the percent of total credit sales, the ones that resulted in an accounts receivable. All right, now if you recall, step 1 was estimating the bad debt expense in the current period. Step 2 is when the customer actually defaults. Then, and only then, do we do what we call the write-off. The write-off means I actually take that amount out of my accounts receivable. I no longer expect to collect it. And we do that first by clearing out that allowance for doubtful accounts by the actual amount that has been defaulted on. So I'm going to debit allowance for doubtful accounts. Why do I debit? Well, I'd initially had a credit amount in there, right? So in order to clear it, I have to debit it. And also, it's a contra asset account, so its normal balance is a credit. So to clear it, I have to enter a debit. If I'm debiting allowance for doubtful accounts and I'm writing off this amount, it means I need to credit my accounts receivable account. So let's practice. We've got Crimson Company. During 2011, they had credit sales of $620,000. Now, based on management predictions and their history, they estimate that 1.43% of them will default. Now, in addition, during 2011, there was a customer that defaulted on $524 of an invoice that was related to goods purchased in 2010. Now, we also get a little bit of information on what were the balances in Crimson's accounts receivable and the allowance for doubtful accounts account, which we will use shortly. But first, let's estimate the bad debt expense for 2011. We're going to use the percent of credit sales method. And this is Cornerstone 5.2, by the way, in your book. So percent of credit sales. Remember, step 1 in the allowance method says I have to estimate the bad debt expense for the current period. So I've just hit the end of 2011. I'm an accountant at Crimson Company, and I have to make an entry for what I expect will be the amount of this year's credit sales that we won't receive, we won't collect. If we're using the percent of credit sales, then our bad debt expense will be the percent we believe to be uncollectible times the total credit sales. Well, what was the percent we believe will default? 1.43%. What was the total credit sales amount for 2011? $620,000. If we multiply those two together, we get the 2011 bad debt expense of $8,866. Now, just a reminder to all of the... Now, just remember that 1.43% would be written 0.0143. We multiply that by the total credit sales, and we get 2011 bad debt expense of $8,866. So now, we also remember that the information told us that during 2011, there was an actual customer who actually defaulted on exactly $524 from purchases in 2010. Now, in the allowance method of dealing with bad debt, we don't write off until the customer actually defaults. A customer has actually defaulted, so can I write it off? Yes. What does it mean to write it off? Remember, a write-off means I reduce the accounts receivable. So how would I reduce accounts receivable? Well, I'd have to credit accounts receivable. Now, you might be thinking to yourself, what's the other piece of that entry? Well, it would be a debit to the allowance for doubtful accounts account. Now, we didn't deal with any of the entries from 2010, but if this is a company that uses the allowance method for bad debts, then we know that at the end of 2010, they had made some sort of estimate of bad debt expense. They had expensed it during 2010, and they had entered that amount into what we call that holding account, the allowance for doubtful accounts account. Now, on December 31st, 2011, they've actually experienced a default from the amount they had set aside in 2010 in the allowance for doubtful accounts. So now they need to debit the allowance for doubtful accounts, they need to credit accounts receivable, and now they've taken care of the write-off. Now remember that $8,000 and change amount of bad debt expense that they were estimating for 2011? They need to make an entry for that also. Now remember, in the allowance method, in the same period, we're talking about 2011 bad debt expense estimate, and we're recording it at the end of 2011. We're going to expense our estimate, and our estimate had been $8,000 and change, right? $8,866. How do we record an expense? Well, it's going to be a debit for $8,866. And then what else do we need to do? Because we're just estimating right now, we're not actually writing it off yet. Exactly, we need to make a credit entry to that holding account, the allowance for doubtful accounts. And so this is what our journal entry would look like. Now, sometimes it's helpful to think through what would our accounts receivable balance look like at the end of 2011? And what would the allowance for doubtful accounts balance look like? What if that $524 of write-off had happened? What if it had not? So let's check it out. We've got some information on what the opening balance is for accounts receivable, was $304,000, and for the allowance for doubtful accounts, which was a credit of $134. Remember that allowance for doubtful accounts has a normal balance of a credit. All right, so we know that the beginning balance for allowance for doubtful accounts is $134. Let's assume the write-off happened. Do you remember what the actual amount that a customer defaulted on in 2011? Right, it was $524. And if you notice, that's a debit amount, right? Because this is the debit side of an account. This is the credit side. It was a debit to allowance for doubtful accounts. Were there any credit entries to the allowance for doubtful accounts? Well, there were. There was a credit entry for $8,866, which was the exact amount of the 2011 estimated bad debt. So what would the ending balance be? We've got credit of $134, we've got a debit of $524, and another credit of $8,866. Well, we'd have a credit balance of $8,476. Now let's look at accounts receivable. Let's assume the write-off happened, right? The information in the problem said that accounts receivable started with $304,000. If there had been the write-off, we know that there was that journal entry which credited accounts receivable for $524. We also know, based on the allowance for doubtful accounts, that we have a total subtraction from accounts receivable of $8,476 if they were all written off, in which case the new balance for accounts receivable is $295,000. Now, what if that $524,000 had not been written off? Well, the allowance for doubtful accounts would be $524 higher, right? Because we just wouldn't have this, which means it would be $9,000. $304,000 minus $9,000 is going to be $295,000. What's the upshot here? Yeah, when we're doing the allowance method, accounts receivable is no longer affected by the exact amount of write-offs, because accounts receivable is dealing with the estimates, and all of that can be seen right here. Again, the normal balance for the allowance for doubtful accounts account is a credit balance. Each year when we estimate bad debt expense, we make a credit entry. Each year, if there are any write-offs, we have debit entries. It reduces the allowance for doubtful accounts. Accounts receivable has a normal debit balance. Oops, our pen is not working. There we go. Debit balance. Any write-offs will reduce accounts receivable, actual amounts that are defaulted on. If we consider all of the allowances for doubtful accounts being written off, then that would also reduce the accounts receivable. So let's wrap up this section. Remember, we had 3 contra revenue accounts. There were 2 contra revenue accounts for 3 different circumstances that we covered in the first video. The sales discounts account, which reduces revenues, and the sales returns and allowances account, which also reduces revenues. And that happens for sales returns or sales allowances. There is also what we just talked about, a contra asset account, and that is the allowance for doubtful accounts, which we use in the case of bad debts. So now, throughout Chapter 5, we have dealt with 3 different contra accounts. There's 2 contra revenue accounts and 1 contra asset account.